Look around you right now. Literally, almost everything you see can be bought on EMI. I'm talking about that brand new smartphone in your pocket, the bike you ride to work, the vacation you just got back from, and I'm not even kidding, there are actually EMI options for your Friday night pizza delivery. No way, right? But here's the thing. What seems like a super affordable purchase today can quietly sneak up on you and morph into this long-term financial trap that locks you in for years. So today we're going to unpack exactly how this happens in this explainer. A lot of middle-class families out there aren't actually financially stressed because they earn too little. No, they're stressed because their future income is already claimed by easy loans way before it even hits their bank account. So let's break down this whole EMI cycle.
Okay, so there is this absolutely brilliant, but honestly kind of dangerous psychological trick at play here. Have you ever wondered why companies push EMIs so aggressively? It's because it completely rewires your brain. Think about it. Traditionally, when you wanted to buy something, you asked yourself one simple, responsible question. Can I actually afford this? Right? It was all about the total cost. But EMIs, they change the question entirely to, can I afford the monthly payment? And just like that, boom, your brain completely disconnects from the actual total value of the item. You're just focusing on this tiny, manageable little slice of the pie. It is a total marketing masterpiece for sure, but man, it's a massive personal finance trap.
Let's dive into this. We see it everywhere, right? Zero down payment, just 2,999 rupees a month. It flashes on giant billboards, it stalks us across every shopping app we open, and it does a really good job of making an incredibly expensive item feel instantly affordable. Our brains are basically wired to think, well, yeah, I can easily spare $3,000 this month, no problem. But this tiny number completely blinds us to the real financial burden. Because guess what? You aren't just paying 2,999 rupees. You are actually committing a solid chunk of your future time, your energy, and your hard work to something that's probably losing value the second you buy it, all while paying sky-high interest on top of the whole shebang.
And this brings us right to the instant gratification trap. You know the feeling. You see a coworker flexing some luxury trip on Instagram, or maybe your friend just showed up with the newest phone, and suddenly that urge to look just as successful kicks in, and it kicks in fast. We want the luxury right now, before we have the actual financial foundation to afford it. We call this dopamine spending. It's basically impulse buying driven entirely by the thrill of the purchase rather than, actually needing the thing. We buy stuff to impress people, but the reality is, in doing so, we're just quietly turning up the invisible financial pressure on ourselves. Now, a single EMI of 3,000 rupees, that feels like a drop in the bucket. You can manage that easily, right? But the real danger starts when multiple small EMIs slowly combine together. That's the trap. It's the snowball effect. You add a laptop here, maybe a bike there, throw a credit card bill into the mix, and suddenly the math completely flips on you. Let's actually look at the harsh mathematical reality of your cash flow for a second. Just imagine a standard starting salary of 50,000 rupees. Before the month even begins, that hard-earned salary is just eaten away, slice by slice. A slice goes over here to the phone EMI. Another slice goes to the bike. A massive chunk gets swallowed by credit card minimums, and then there's another piece gone to a personal loan. What are you left with? Just this tiny, sad little sliver of leftover cash. Poof! It's practically nothing. And what does that mean? It means you have absolutely zero room for an emergency fund, zero room for investing, and zero room to actually grow your wealth. Your cash flow is completely destroyed, and you're stuck relying entirely on your next paycheck just to survive the month. When income increases, but liabilities increase faster, financial freedom keeps moving further away. Think of this as your ultimate elder brother reality check. Let's say you get a promotion, you get a solid raise, or you move to a much better paying job. Awesome, right? But if your immediate reaction is to upgrade your lifestyle by taking on more, slightly larger EMIs, well, you aren't actually getting richer. You're really just upgrading the size of your financial cage. It's like you're running faster and faster on a treadmill, sweating it out, but staying in the exact same place. Have you ever noticed just how frictionless online checkouts have become lately? That is the modern evolution of this trap, buy now, pay later, or BNPL. It is literally everywhere on your checkout pages. BNPL is specifically designed to remove the psychological pain of parting with your hard-earned cash at the exact moment you hit buy. With these instant, super easy approvals that require absolutely zero paperwork, it creates this massive disconnect. You honestly forget you are taking on real debt. It just feels like this convenient little app feature, but make no mistake about it, it is a short-term loan, and it thrives entirely on consumer forgetfulness and the inability to pay on time. Which leads us straight into the minimum payment trap. Listen, if you are using credit cards or BNPL apps and you're only paying that little minimum due amount each month, you aren't managing your debt. You are literally digging a grave for your finances. That minimum payment is a carefully calculated illusion. It keeps your account looking like it's in good standing while allowing these sky-high interest rates to start compounding against you in the background. The math works silently, day after day, ensuring that you could end up paying double or even triple the original price of whatever it was you bought, just stretching the pain over a much, much longer period. Now, let's be completely fair here. Loans themselves are not inherently evil. They are just a tool. The real secret is knowing the difference between good debt and bad debt. Good debt acts like a stepping stone. Think of things like an education loan that gives you valuable skills to drastically increase your future income, or maybe a business loan to scale a venture, or even a reasonable home loan. Bad debt, on the other hand, is purely lifestyle debt. We're talking about luxury phones, expensive bikes bought just to show off, or vacations funded entirely by swiping a credit card.
So here is your golden rule for the rest of your life. Good debt helps build future income, while bad debt steals future income. It's really that simple. If the money you're borrowing right now doesn't have the potential to put more money back into your pocket down the line, it is simply stealing your future income. Remember, loans aren't the enemy here. It's the careless use of debt for instant gratification that completely locks the middle class into this endless cycle of stress.
And speaking of stress, we absolutely have to talk about the hidden emotional cost of all this. Because debt doesn't just drain your bank account, guys. It actively drains your life energy. When your entire salary is committed to EMIs, you're essentially living in a forced survival mode. You're constantly dealing with this baseline of financial anxiety. And worst of all, you lose your freedom. You become completely dependent on your job. You can't take a career risk. You can't start that side hustle you've been dreaming about. You can't even quit a toxic workplace. Because those monthly payments, they don't care if you're miserable. They just demand to be paid. The mental pressure of that is just immense.
So how do we fix this? Let's move on to escaping the trap, how youth should think about loans.
Okay, if you're watching this explainer right now and getting that sinking feeling that you might already be trapped, don't panic. Here is your roadmap out. First things first, you have to rewire your brain to buy below your affordability. Don't stretch your budget to the absolute maximum just because some bank's shiny EMI calculator says you're quote-unquote eligible. Once you've made that mental shift, step one is simple. Stop taking new, unnecessary loans immediately. You've got to freeze the bleeding. Step two, list all your debts clearly on a piece of paper. Face the harsh reality of the numbers. Step three, prioritize paying off the highest interest debt first, which, let's be real, is almost always your credit cards. And finally, step four, avoid emotional panic. Look, at the end of the day, this is just a math problem, and math can be solved with time, discipline, and a solid plan. Actually, for a much deeper step-by-step repayment strategy on all this, I highly recommend checking out our Day 7 Mastering Loans Explainer. It's a real game changer.
Now, fully escaping this trap means you have to learn how to turn a blind eye to societal pressure. As the saying goes, wealth is often built quietly while fake wealth is displayed loudly. True wealth isn't that flashy new car you bought on a 7-year loan just to show off on Instagram. No, true wealth is the quiet peace of mind of having zero consumer debt, a rock-solid emergency fund sitting safely in the bank, and investments that are just quietly compounding in the background while you sleep. I want to leave you with this final thought today. The next time you're staring at a big purchase, I want you to stop and ask yourself, are you building your future freedom right now, or are you just selling off a piece of your future income? Really think deeply about that before you hit approve on your next EMI. Because building real wealth is way less about exactly how much money you earn and entirely about what you do with that money over the long term. Start prioritizing your freedom over temporary status.